The price of everything that you purchase will go up soon when the 2 percentage point increase in the Goods and Services Tax, or GST, is phased in by 2025. Take, for example, a cup of coffee that costs $1 before GST. When you add the current rate of 7% GST, the total price of the coffee will be $1.07. When the GST is raised to 9% by 2025, that cup of coffee will cost $1.09, or almost 2% higher than its current price. Including other factors like inflation, the price of that cup of coffee will go up even further. With the economy rebounding from the COVID-19 pandemic and growing at a pace that is higher than the country's potential growth rate, IRVIN SEAH at DBS believes it is time for a GST hike.
Because of an aging populations and the need to also essentially strengthen our social safety net. The government has been increasing its social expenditure significantly, especially when it comes to healthcare. This is recurring expenditure. So therefore, it has to be funded by recurring income.
GST, which is a tax on spending, is one such recurring source of income. It is much more fiscally sustainable than other options like personal income tax revenues, which will dwindle as the workforce ages.
GST is imposed on expenditure. So it doesn't matter whether you're working or you're retired, you will require to spend. So the taxes from consumption will be very stable, unlike income tax.
As consumers grapple with higher costs of living and a drop in their purchasing power, they may want to relook their household budgets.
GST is like a spending tax. A good starting point would be to split your expenses into two types. One is the fixed expenses, one is the discretionary expenses. So you have to think of ways to review and reduce the discretionary expenses.
The government has set aside a support package worth 6 billion Singapore dollars to help lower and middle-income households to cope with the GST hike.
The amount that they will receive is enough to offset the GST that they have to pay for up to 10 years. So this is quite a significant amount, and this will help to mitigate or offset the regressive effects of the GST. By itself, the GST is regressive. However, if you consider the offset measures that have been put in place, it will reduce the regressiveness.
Unlike individuals who will all be affected by the hike in one way or another, the impact on businesses is mixed.
For companies that are GST registered, the direct cost wouldn't be felt because GST is claimable. Then you have the other SMEs that are not GST registered or which usually are smaller ones. You have the hawker centers, the hawker stores, the hawkers, and others that are smaller than $1 million in turnover, right? And in these cases, then the GST would impact them because then they would either have to absorb it or they would have to then pass on the cost.
On concerns that the island's economic competitiveness will be affected, experts point out that even after the GST increases to 9%, Singapore's GST rates remain comparable to those of its peers.
We must bear in mind that GST is a tax on consumption and basically domestic consumption. For example, all our exports are effectively zero-rated, so it doesn't impact upon our exports and our competitiveness. Would it impact the foreigners? My personal feeling is it will not, because if we look around our neighbors are hovering around 10%. But if you look further afield to the European Union, their average VAT, which is our GST equivalent, is between 20 and 25%. So even at 9%, we are relatively low in terms of consumption tax.
Besides GST, There is another potential source of income that the government could tap on: taxes on what an individual owns. Tax experts have proposed bringing back a real estate tax.
Up to 2008, we actually have income tax on annual value of property. So if you stay in a very big house and your annual value is 200,000, the first 100,000, 150,000 is exempt, but the excess 50,000 is taxable as your income. And this is another form of wealth tax. The other is previously, when you leave your property vacant, you will be taxed on the annual value. And now I notice very rich people, they have 2 or 3 properties, they leave them vacant. In the past, if you leave them vacant, you have to pay income tax based on the annual value.
Other options include a capital gains tax and estate duty tax, which was abolished in 2008.
In terms of financial planning, we used to help our clients to plan for estate duty tax when it was implemented in Singapore. So one of the consideration may be to bring back this wealth tax, because it's actually limited to affect a limited number of individuals in this case.
Whether wealth taxes will be implemented, and which wealth tax, it has to be balanced against maintaining Singapore's status as a wealth management hub.
We have to be mindful that, the more we tax on the wealthy, the more likelihood that they will move their wealth out of Singapore. And we will have a wealth drain issue as well. So it is a difficult policy trade-off.